This is not over. There's been a little bit of a sigh of relief. Stock market rallied a little bit toward the end of beginning of April. And okay, that's a normal reaction. But any thought that the problem's been solved, the bailout's complete, you're not going to hear more, is just not true. There's more coming. Get ready for it. I can't tell you. I'm not going to pick a specific name, and we all know the names of the big banks that might be in distress. Is Deutsche Bank or Barclays or HSBC, Santander. I'm not picking on any of them. I'm just saying that there are more dominoes waiting to fall. The really interesting part about this, and again, we can come back to the specifics, is that the dominoes falling is a good metaphor. It's, if you got 100 dominoes, you knock the first one, they're all going to fall. That's just physics. So how do you stop that? How do you stop that crisis? Well, you truncate, you drop a steel wall between two dominoes, and this one hits the wall and this one's still standing. But that's the bailout. But the problem is each crisis tends to get bigger than the one before, which means each bailout gets bigger than the one before. My question that I'm wrestling with, are we now at the point where the needed bailout is bigger than the capacity of the central banks, that they've pulled all the rabbits out of a hat, played all their cards? And again, this goes back to what I did say about the Silicon Valley Bank rescue. It is the biggest bailout in history, and I can explain why. But if that's the case, and what else do they have? And then, so now we're dangerously close to the point where, as the crisis gets worse, it's no longer, oh, gee, let's wait for the Fed to bail it out, or let's wait for the ECB to bail it out. You get to the point, I think we're there, where you say, no, these guys actually can't stop it. And you lose confidence in the currency itself. It's the dollar. The crisis is the dollar itself, and the euro, goes along with that. And then that's the crisis. And there's no way to bail out a dollar crisis with dollars, because you're just pumping more of what people have lost confidence in. And then, then where do you go? And there are good answers to that. We've seen it again. We've seen it all before, but you have to kind of take the timeline out to 1,000 years, or the 1350s with the failure of the Bardi and Peruzzi banks in Florence, to see how these things can really play out. So this is big. It's not over. The regulators will attempt more bailouts, but we're at the point where I think you can start to question the regulators themselves. Brazil, Mexico, Argentina, the Latin American debt crisis, broadly defined in the early 1980s. That played out, the intense phase lasted about 3 years, 82, 83, 84. It wasn't until 1990 that we got around to Brady bonds, which were the ultimate refinancing technique. But the intense period lasted about 3 years. Come forward to 1998, long-term capital management. That was about 3 months. That was July, August, September 1998. SVB was 3 days or less. It was like Wednesday, Thursday, Friday, and done. We were moving $8 billion out of Silicon Valley Bank, and we got the wire transfer request in, but we didn't know, because you get to close business Thursday. We didn't know until Sunday that the money was going to move. We got a confirmation on Monday. We did end up moving the money, but there was about a 48-hour period there from Friday to Sunday when no one knew that the wires had been completed. The recipients didn't have them. It was just in limbo, and it worked out. And they talked about, all these small entrepreneurs and startups. They got 100 employees and $5 million working capital, and that money's gone, and they're all going to fail. There was something to that, but the fact is, you had Roku, Cisco, eBay. I mean, there were huge companies with multi-billion-dollar deposits in that bank. It wasn't all a bunch of little guys. So, but yeah, you can. In the old days, you had to line up around the block, and maybe it was raining. You're standing there in the rain, waiting for your turn to get up to the tower. Now you can be in line at McDonald's, with your cell phone, and just a couple hits, QR code, and boom, $10 million is gone. And what Peter Thiel did, and he was right. I mean, I'm not criticizing him. He got his own money out, but he sent out like an SOS to Silicon Valley. He said, all of you, whoever you are, get your money out now. And a lot of people did, and that was that $40 billion. So the time frame is becoming more compressed because of technology. You're exactly right about that, which means that the response function has to be equally compressed, or else you are going to have all the consequences of an honest to goodness global financial crisis. So, and I'm not sure if everyone knows the sequence, but on Friday night, March 10th, the FDIC took over Silicon Valley Bank. And they issued a press release, and they said, here's what we're doing. We're taking over. We're putting it into what's called a receivership. Anyone with $250,000 or less, your deposits are fully insured, no worries. You'll have your money Monday morning, and over $250,000, your deposits are gone. They didn't say frozen. They didn't say suspended. They said gone. And they gave you a receivership certificate, basically an unsecured printed up IOU from the FDIC, but not money. And it's a receivership certificate. And they said, hang on to them. In effect, we're going to sell assets. And as and when we realize proceeds from assets, we'll give you something. We'll give you distributions on these things. Don't know how much, don't know when. We'll do the best we can. Remember in the RTC days in the early 90s, it took them 2 years, and they were very efficient. I worked with them at the time. We were in their offices when we were sitting on boxes because they didn't even have furniture, but they were doing deals. So they had the right attitude, but that took 2 years. So, and that was it. Well, that's when I call the billionaire crybabies came out in force. Bill Ackman, all these guys. Oh, you got to save us. I was like, well, you got to trade on Bill. $5 billion is not enough. But anyway, they pounded on the White House all weekend. Now here's something that very few people. Almost nobody knew at the time except the management, although they seem to be asleep at the switch. Everyone's like, yeah, startups, venture capital. There's a lot of truth to that. 97% of the deposits at Silicon Valley Bank were uninsured. And by the way, that's my new metric for assessing banks. You used to look at, working capital and debt equity ratios and, bad assets, governments. There are lots of ways to measure the health of a bank. But the most relevant way right now is, and this is publicly available, take the ratio of uninsured deposits to total deposits. 30% is comfortable. If you're like, 70% of my deposits are insured, which means they're not panicky. They're not necessarily going to run for the hills. 30%, okay, uninsured, but I have assets. I have that much cash or more. That's a comfortable ratio. When you get over 50, you're in the danger zone. Well, Silicon Valley Bank was 97% uninsured, which meant all the money was going to run, and it did. So that's a way, if you're looking at these big banks or any institution or your own savings institution, to look at it. But Silicon Valley Bank was a climate bank. Were they investing in startups? Yes. Were they investing in technology? Yes. But these were climate. These were green new scam startups looking at battery technology, chemistry, physics, to try to make a better battery. But not much improvement in the battery in 200 years, but they're working on it. Wind turbines, other sustainable fuel alternatives, et cetera. Again, I'm not do that if you like, if that's your field of research, but so much of this is subsidized by the government and then further subsidized by Silicon Valley Bank. And that's where the assets were. That's where the loans were, by and large. And so the White House is getting hammered, not only because of entrepreneurs, job losses, and by the way, we are in an election cycle here in the United States, but from the greenies, who are extremely powerful. Sunday night at 6 o'clock, by the way, mark that on your calendar. Sunday, 6 p.m. is when they tell you what they're going to do. 6 p.m. Sunday, November 12th, they came out on, March 12th, they came out on Silicon Valley Bank. The following week, 19th, that was Credit Suisse, and then the week after that was something else. But they always announce the collapse on Friday, and they announce the relief on Sunday, so they have the weekend to work on it. But you got to be careful about 3-day weekends. Easter, Easter is an example. If you have underwater bonds, U.S. government securities, treasuries or certain mortgages, you can ship them to us. We will give you a loan at par value. We'll give you cash equal to par value, even though the loans are only worth 80 to 85 cents on the dollar, because interest rates have been going up for over a year. The value of the bonds goes down. That's bond math 101. Rates up, bonds down, prices down, rates go down, the prices go up. Well, the rates have been going up, so the prices are down. So these bonds are worth 80, 85 cents on the dollar. But here's the Fed saying, we'll give you 100 cents on the dollar for your 85-cent bond on a 1-year loan. So the loan was important because it means they didn't actually sell them. It was collateral for a loan, except you're under collateralized. And the Fed's like, okay. I said, I have a 14-year-old car that my dealer says he won't give me any money for. So I sent a tweet out. I said, hey, Fed, would you give me the $70,000 I paid for it? It's not worth anything, but let's get back to par here. That's what the Fed was doing for the entire system. But the thing is, Brian, you're talking about multiple.